what I want to do is just tell a story from first principles, and I hope you'll bear with me, but it has something to do with leverage, liquidity, and class. So let me start simple. There's a person in a house. I'm a bit distressed to say when I went into the men's bathroom a little while ago, the symbol on the door looks exactly like that. And I want to reassure you that this is not intended to be a man in front of a house. If I wanted it to be a man, there could have been artistic additions that could have been put onto that symbol that I actually chose not to put on. So I want you to just understand this is a person in a house.
That is not gender neutral.
That is not gendered. Not gender neutral, why? Hips too narrow?
Nothing in between the legs.
Anyway, so let me add a familiar story to this person. They do productive activity in their home with the people who they live with. As we know, these are all debated areas, but we know that domain of analysis. And we can also add a familiar story that this person goes to work and sells their labour power and produces commodity output which gets converted into money, i.e. they produce surplus value. Again, a debated area, but we know what this sort of bit of analysis looks like. So let me add a bit more. Let me add some finance. We know that this person goes to a bank or some other money dealing agency and gets a loan for which they pay interest. There are certain heterodox economists who have in the past attended this conference but now don't attend this conference, who get completely stuck at this point, and they say, look at the problem we're facing, levels of debt, levels of interest repayment, these households are non-viable, we're all going to hell in a handbag because of debt, and etc. So you know who I'm talking about, but there's more than one of these people, but there's one with a very big mouth.
Now at Kingston.
Oh, Jim, I was trying to be discreet. But the issue isn't debt per se, because we know households have balance sheets. And one of the interesting things that has developed is that we are now being asked to think of ourselves and our household as if we were a balance sheet. In a book I've just sort of finished writing with Michael Rafferty, sort of, because I know we'll keep dabbling in it for a little while, we're talking about you're running a household hedge fund. You're asked to take long and short positions, you're asked to borrow, and you're asked to accumulate wealth. Why? Because simply going to work and selling your labour power isn't going to get you a satisfactory retirement, it's not going to make you wealthy. So you have to manage your balance sheet, and that balance sheet has income and expenditure and asset and liability dimensions, and of course risk management is now an expectation of households. So the story really, when it comes to finance, is all about household balance sheets. And when we look at not the income and expenditure part, but the asset and liabilities part, here's what we see. The sorts of assets that are, and this is where I've been doing most of my work in the last year, looking at these balance sheets by different wealth and income quintiles. Just one, that all looks pretty familiar to you because you'll have an entry amongst many of those items in your own household balance sheet. Just notice one little thing though, skill or labour power never appears in accounts as an asset, even though there is an income that comes from that asset in the income expenditure survey, and education, now it's being priced so high, is increasingly being thought of as an investment in an asset. But nonetheless, the national accountants refuse to think of skill or labour power as if it were an asset. But financial markets do. Here's the little cover of a magazine I saw recently. Is your client a bond or a stock? You're a bond, for example, if you're a tenured academic, because you have a safe, stable, long-term income. You're a stock if you're a casual academic, or if you're self-employed. So when financial planners are planning your household balance sheet for you, they'll say, according to whether you in your labour power are a stock or a bond, so you should shift your exposures around in your household portfolio. So let's be clear, we don't think of ourselves as capital assets, but the financial markets do. So when we go to this household, we have a couple of issues here. Notice what the primary assets of household are. They are labour power, a house, home contents, and a car. If we go up the income stream or the income level or the wealth level, in the top quintile of wealth holding households and income households, we're going to find trusts and other investment assets, second properties, third properties, etc. But for the middle quintiles and certainly for the lowest quintile, for the lowest quintile, the principal assets are labour power and home contents, and maybe a car. For the middle quintiles, there's of course a house that's either owned or in the process of being owned. So let me ask you two questions. When we look at this profile, and you know I'm rushing through this stuff, this profile of households as a balance sheet, how diversified is a household portfolio? If you compare it with a hedge fund proper that's got massive spreads of different risks in different markets, we could say households have remarkably narrow or undiversified portfolios. Rich households, quite diversified. I could give you the details, but I won't. Rich households, quite diversified. Poor households, interestingly, moderately diversified. Households that aren't in the race or aren't in the game of buying a house because their income's too low to buy a house, their portfolio is actually more diversified than the middle. In the middle, everyone has thrown everything into the purchase of a house, so they are incredibly undiversified. The second thing to say about these household balance sheets is that apart from the top decile, the top quintile, the assets are incredibly illiquid. After all, most of those assets listed there are the means by which people subsist. Their labour power, which can't be traded at all, so it's illiquid. Their home, that they can't really sell because they're going to have to get some other sort of accommodation anyway, so they're going to have to spend income on rent, even if it's lower on mortgage. But they need somewhere to live, they need utilities, they probably need a car, and they need home contents. These are not liquid assets. So that's the two characteristics that we're going to find of everyone below the top quintile of households. They are stuck with a very narrow asset profile and an incredibly or an innately illiquid profile. So bear that in mind, that rather than just looking down here at, as some people will focus on, levels of debt and debt repayment and the disaster that it is, we also have to take on their household balance sheets, which have assets and liabilities as well as income and expenditures. And the household is increasingly being seen in terms of these income and expenditures and asset and liability formations. No, I'm going to not go there yet. Let me add then another level of financialisation. That as well as people going to banks and borrowing, they are also undertaking payments to large corporations through contracts. And there is a recent development in households where more and more household expenditures are being contractualised. So we're talking insurance policies, but we're also talking, of course, gas, electricity, telephone are all being undertaken by contracts, by long-term, at least 2-year contracts. And that leads to the process of securitisation. So when we look at what's being securitised in the form of mortgage-backed and asset-backed securities, we can see it's partly the mortgage here that's being securitised through mortgage-backed securities, but we can see certainly in the US, but to a lesser extent in Australia, there is a massive securitisation of insurance payments and household utility payments. They are growing. I mean, they crashed in 2007, 2008, but they are growing again at a rapid rate. So notice something just in passing. Our focus traditionally in political economy has been here, of people going to work to produce. I want to put to you another proposition, that people here in their borrowing and interest repayments and in their payments to insurance and utility payments, they are producing. They're producing the raw materials for asset-backed and mortgage-backed securities. They are producing the inputs. We need to think perhaps a bit differently, a bit more broadly about the way in which we frame the concept of production. But let me come back to that. So just a little bit of evidence there that I'm not going to spend any time on. US data, I could have put in the Australian data, and I felt the heel from the Australia Institute session that I've used US data rather than the Australian data that I could put in. So you can see there that, no, I'm not even going to talk about those. So these are the types of asset-backed securities that are being issued in the US, and you can see almost half of them are auto loans, but also we're finding equipment, housing related, other student loans at the top. In other, it's mainly utilities, but it'll be things also like childcare that's starting to be securitized, childcare payments. So there are the emerging others. So the critical issue for capital is the need to manage household risks. If there are going to be issued mortgage-backed and asset-backed securities based on household payments, the financial concern is to make sure people stay on payment. We know the top quintile will basically be good payers, but there aren't enough people in the top quintile for the amount of securitization that's occurring. Securitization is reaching down into middle income people who are being squeezed because they've got a big mortgage. So the critical issue is, how do you have AAA rated asset-backed and mortgage-backed securities where the foundational producer of the asset for the securitization is someone who's financially precarious? Yeah, so you have to put in place, as a policy position, you have to put in place a whole lot of structures that make sure people will meet their contractual obligations. You've got to do whatever it takes. And so we find there's a cultural issue here about responsibilisation. We find nudge policies. We find changes in the US in bankruptcy laws, such that, for example, credit card debt when you're divorced and the alimony payments are due, according to bankruptcy laws in the US now, you have to meet your credit card debt before you meet your alimony payments.
Oh, right.
Fair enough.
Lending tied to repay, so you've got to take out all these sorts of insurance, and we're finding a very active and increasingly active monitoring of household balance sheets. So we find, for example, at the St. Louis Fed, there is a big and dynamic and active Centre for Household Financial Stability, and the person who heads that describes the global financial crisis as a household balance sheet crisis. What happened? People stopped paying the mortgage. What do we have to do about it? We've got to make sure people pay the mortgage. We may have to say we've got to restrict who gets the mortgage, we've got to get rid of subprime. But the active frontier of policy intervention isn't about restricting banks. That's too hard. But what you can do is you can intervene to manage households and keep households on payment. And the central bank literature is full of this sort of stuff. We also find, of course, the IMF in 2005, I'm sure they regret ever saying this, but they described the household sector as the financial system's shock absorber of last resort. Now I'm going to jump through all of that because I know I'm running short of time. It's about, they're just slides about how important asset-backed and mortgage-backed securities are becoming in the market, but I'm just going to go ahead of that. So, let me jump then to trying to think about a class politics that follows from these observations about household payments being used to form the raw materials of mortgage-backed and asset-backed securities, and on those slides I just skipped on, how much demand there is out there in the market for these mortgage-backed and asset-backed securities. And I will jump back just parenthetically to say that the reason there is so much demand is that with negative yields on treasury bonds around the world, investors, particularly pension funds, but hedge funds too, at the safe end of their portfolio, they're looking for something that is both safe and gives a reasonable yield. And the thing that is safe and gives a reasonable yield now isn't treasury bonds, it's mortgage-backed and asset-backed securities. Why are they safe? They're safe because households are being so heavily surveilled by central banks and private banks that they now know who is at risk of default, who are we going to lend to, who are we not going to lend to, etc., etc. So these securities are now filling the safe end of the asset portfolio. But the politics that comes here is Labor has three faces. Labor is, as we familiarly know, it's a producer of a surplus in production. surplus value. It's an illiquid asset class and it's an absorber of risk. So let me go back to my diagram. Surplus value that gets produced here. If we put it in financial language, we could think of it as a production spread. The difference between the value of labour power and the value created by labour is a spread. Yeah, we call it surplus value, but it's a spread. And that spread goes up and down according to class forces and all those theories we know. It's just a reframing of the familiar. We know households also face a yield spread according to how successful their property investments are. For example, they borrow, they buy a house, they have a yield spread. For some people it's positive, for some people it's negative. That doesn't particularly interest me, except to make the point that culturally we have all been turned into investors. We've all got to be players in the yield spread, whether we're successful or not. But up here at the top, and I couldn't even reach it if I was tall, we have a liquidity spread. That is, households that are highly illiquid with really narrow portfolios are facing huge risks in financial market terms. Yeah? Anyone who's got a narrow portfolio that is illiquid, they're a sitting duck in the world of risk trading. Households are sitting ducks in the world of risk trading. There they are with their illiquid assets because they are their means of subsistence, and they sit on those assets and sit on those assets. But while the household itself is illiquid, they are giving rise to asset-backed and mortgage-backed securities which are highly liquid. There is a risk spread. Where is that risk spread coming from? It's coming from households absorbing risk, living a volatile life in terms of their exposure in the labour market, a volatile life in terms of the experience of the value of their house and their superannuation, but they're churning out these payments that are making AAA rated highly liquid assets. Households are absorbing risk. So my question to us as Marxists and even as post-Keynesians, we focus here, we are preoccupied here and say, oh, this is the exploitation of the subordinate class. It occurs in the process of production. I'm saying, yeah, it does. But the action now is up here. It's in the liquidity spread. Households are absorbing risk, and they're absorbing more and more and more risk, and no one talks about it. So the bottom line, I think I just said it.
Thank you.
Yeah, that'll do. Thank you.
Where's Mark?
He's in New Zealand. He got told he's got to take annual leave because he's got more than 8 weeks annual leave. So he had to take leave, so he's in New Zealand serving. Since you asked.
Securitize that.